After opening the week a tad higher at 73.15, the rupee registered a high of 73.04 and 73.7325 in the last week. The rupee maintained its firm undertone against the dollar in the range restricted between 73.30 to 73.60. The rise in dollar against the major currencies had little impact on the rupee. Banks are anticipating more FDI, private equity, and expatriate remittances to hit the market in the next 1 to 2 months time frame, and we expect the rupee to breach the 73.00 mark and test the next resistance at 72.50. The various market operations conducted by RBI to control the upsurge in sovereign bond yields seem to be temporary, as the huge borrowing schedule by the government in the second half of the financial year could have an adverse impact on the bond yields. The 10-year bond yield ended the week at 6.042%. A gradual rise in the 10-year sovereign bond yield to 6.10% level is on the cards, which could materialize soon. The significant fall in global oil prices and contraction in non-oil imports as a result of the pandemic, the dollar demand in the market will be much lower, and the dollar supplies from trade, current, and capital account related transactions shall dominate to take the rupee significantly higher in a short period of time. However, the intervention from RBI to curb the rupee volatility shall lead to zigzag movements in the domestic currency with bias on the upside. At some point of time during the rise of rupee against the dollar, the market would flash their concern on overvaluation in the real exchange rate in the context of inflation remaining high over the short term. The market concerns on significant overvaluation in the real exchange rate of the rupee will act as a speed breaker to contain and normalize the rupee's uptrend. The mismatch between the supply and demand for dollars is very much evident to gauge an up move in the domestic currency, as the geopolitical situation seems to be normalizing. The rupee is likely to remain within the range of 72.50 to 73.60 levels. We expect the rupee to resume its ascent once the inflow starts flowing in. The discouraging macroeconomic fundamentals led by a rise in fiscal deficit and the fact the pandemic situation not brought under control as yet reflects the gloomy economic outlook. Despite the bleak economic outlook in the current financial year, the huge rise in capital and current account inflows effectively led to a sharp up move in the domestic currency. The up move in the domestic currency cannot be contained unless there is an active intervention support from RBI. Against the forex payables up to 3-month maturities, the importers are well advised to hedge 50% of their month-wise payables at the current exchange rate, and for the balance 50%, unhedge the portion of forex payables by keeping a strict stop loss at 74.00, which shall provide a favorable average exchange rate to the importers in settlement of their import bills. In the background of the bearish outlook on the domestic currency, we recommend the exporters to hedge their month-wise receivables up to 3-month maturities at the prevailing spot exchange rate of 73.40, 50 or better. Combined with an average forward dollar premium benefit of 50 paisa per dollar, the realization rate for the exporters shall be slightly above 74.00. Though the Fed funds rate and the repo rate remains unchanged, the short-term money market yields in the domestic market have risen by about 30 to 35 BPs, which led to an up move in forwards across the maturities. With the short-term USD interest rates, that is USD LIBOR, are ruling steady to lower, the interest rate differential between the USD and INR interest rates has widened. Due to sharp rise in the rupee against the dollar, the forward curve drifted higher by 20 to 25 BPs across the maturities. The 6-month forward dollar premium ended the week at 4.05% per annum.